All right, today we're diving deep into one of Wall Street's oldest games. We're talking about trading the liquidity trap.
You know that feeling, right? Just total frustration. You do everything right, you follow your plan, you set a totally logical stop, and then bam. The market just surgically snipes your position, and seconds later, it rips in the direction you knew it would go. It's infuriating, and pretty much every single trader has been there.
But here's the thing. What if I told you that wasn't just random market noise? That feeling of being so perfectly, precisely, and painfully wrong, what if it's not bad luck at all?
The truth, it's actually a deliberately engineered event. Yeah, you heard me. It's a mechanism, a trap, set by the biggest players in the game. And in this explainer, we are going to break down exactly how they do it. And this is the best part, how you can start flipping the script and using it to your advantage.
Okay, before we really pull back the curtain, you know the drill, we gotta do our standard disclaimer. Everything in this explainer is for educational purposes only. I am not a financial advisor, and nothing here is financial advice. Trading is risky, seriously risky, so you've always gotta do your own research before making any moves, okay? All right, with that out of the way, let's get into it.
So, to figure out how to beat the trap, we first have to understand what we're up against. Let's really dissect this thing, the stop-out trap, and get to the bottom of why so many of us retail traders end up on the wrong side of the trade, time and time again.
You know, it all boils down to one single concept: liquidity. Seriously, forget everything else for a second. Liquidity is the absolute lifeblood of the market. It's the fuel that makes the whole engine run. Think about it. If you're a massive institution trying to buy or sell millions of shares, you can't just click a button like we do. You need a giant pool of people on the other side of your trade. You need fuel.
And this right here, this lays out the whole game perfectly. On one side, you've got us, right? Retail traders. Our goal is to make some profits, and our action is to place stop losses at obvious, predictable spots to protect ourselves. But the result? We become the fuel. Then you have the institutions. Their goal? Fill these absolutely massive orders. So what do? They hunt for our stop-loss clusters. They literally use our defensive plays as their way in. They use the fuel that we provide.
I love this analogy because it's just so true. Retail provides the gasoline, Wall Street lights the match. Think about it. All those stop-loss orders we place, just sitting there, right below support or right above resistance. That's basically a giant can of gasoline. And the institutions? They know exactly where we put it, and they've got the match.
So how do they actually do it? Well, it's a pretty clear playbook. First, they'll push the price right to those zones where they know we're hiding. Places like yesterday's low, a big round number like $100, you know the spots. That push triggers a cascade of our stop-loss orders. The second your stop gets hit, you're forced to sell. And all of those forced sells create this massive pool of liquidity. It's exactly what the institutions need to buy into, filling their huge positions at a great price. And then what happens? The second their orders are filled, poof. The pressure is gone and the market just snaps back, reversing like crazy and leaving everyone who just got stopped out in the dust.
Okay, so that's the trap. And yeah, it sounds kind of bleak, I know. But here's the good news. Understanding the trap is the first step to beating it. So now we're going to flip the script. We're going to learn how to actually trade the trap by breaking down the anatomy of what's called the sweep. Right, so this whole thing actually has a name. It's called a liquidity sweep. That's the technical term for that sharp, sudden move that just stabs through a key level. It's not a real breakout or a real breakdown. It's more like a surgical strike, designed for one reason and one reason only, to trigger all those stop orders and create liquidity before the real move actually starts.
So here's the big mindset shift. Instead of being the hunted, we need to start thinking like the hunter. And there's a 4-step playbook for this. Step 1, mark the liquidity zones on your chart. Ask yourself, where's everyone else putting their stops? Step 2, and honestly, this is the hardest part, you wait. You have to let the sweep happen. Don't jump in early. Step 3, you look for rejection. This is your confirmation, a big, sharp wick on a candle or price snapping back above a key level like VWAP. And finally, step 4, you enter with control. You place your trade with a very defined small risk for a huge potential reward.
Okay, let's make this super concrete. Here's a real-world example with QQQ. So the setup, everyone and their brother can see that 525 is a big support level. So where's all the gasoline? It's all the stop losses piled up right underneath it. Then, here comes the sweep. The institutions push the price down just a little to, say, 524.80. All those stops get triggered. But then, and this is the key, you see the rejection,
Price instantly rips back above VWAP. That's it. That's your signal. You can now go long, place your own stop loss safely below that low, and ride the real move up. See the difference? You didn't get trapped, you traded the trap.
You know, once you start seeing the market like this, everything changes. It stops looking like a random, chaotic mess and starts looking like a map of liquidity. This isn't just some one-off trick. This is a real, sustainable trading edge.
And the really powerful thing here is that this is an evergreen setup. It works in any market condition because that fundamental need for liquidity, it never goes away. In a screaming bull market, sweeps are used to shake out the weak longs before the next leg up. In a bear market, they're used to trap all the eager shorts before the next drop. And in a choppy sideways market, they happen in both directions, basically defining the top and bottom of the range.
And this all comes down to the most important mindset shift of all. Your job is not to predict the sweep. Don't even try. Your job is to identify the potential liquidity zones and then patiently wait to react after the sweep and the rejection confirm it for you. See, prediction is a guessing game. Reaction, that's a strategy.
So, here's what I want you to do. The very next time you get stopped out of a trade, before you get mad, just pull up the chart and ask yourself a question. Was price at a really obvious level that everyone was watching? Did it just poke through that level and then immediately reverse? Ask yourself, was that a liquidity sweep? Because once you start reframing your losses like that, that's the first step to turning them into your biggest wins.
Hey, if this breakdown opened your eyes and gave you one of those aha moments, do me a favor and smash that like button and drop a comment below. I'd love to hear your own stories about this. And look, if you want to keep learning about the hidden tactics that Wall Street doesn't want you to know, make sure you subscribe to Elite Trade Radar. We dig into stuff like this all the time. Oh, and hit that little bell icon too, so you don't miss the next explainer. The market moves fast, and you don't want to get left behind. Thanks for watching, and I'll see you in the next one.